Imagine waking up tomorrow morning, you check your phone, your investment portfolio is down 30% overnight, the news channels are screaming, social media is in full panic mode, friends are telling you to sell everything before it's too late. Would you know what to do? Because throughout history, stock market crashes have erased trillions of dollars in just a matter of days. The crash of 1929, Black Monday in 1987, the dot-com bubble, the 2008 financial crisis, the COVID crash, different years, different reasons, yet every single one followed surprisingly similar patterns. And here's what separates wealthy investors from everyone else. They don't panic during crashes, they understand them. By the end of this video, you'll know why markets crash, how they unfold, and why the biggest market crashes often create the greatest investment opportunities. Because once you understand what causes fear, you stop being controlled by it. Let's begin. Most people think stock market crashes are caused by numbers, interest rates, inflation, bad earnings, economic data. Every crash starts with something much simpler. Markets run on two emotions: greed and fear. When prices keep rising, people become convinced they'll rise forever. Investors start buying simply because everyone else is buying. Companies become overvalued. People borrow money to invest. Suddenly, it's no longer investing. It's gambling with confidence. Then something changes. One disappointing earnings report, a surprise interest rate hike, a geopolitical conflict, a bankruptcy. Suddenly, confidence disappears. Greed turns into fear almost overnight. And fear spreads much faster than optimism ever could. Our brains still think a red stock chart might be a hungry lion. Except now, the lion is your portfolio. But psychology alone doesn't crash entire markets. It simply lights the match. Once fear appears, economic conditions determine whether it becomes a small correction or a historic crash. One of the biggest triggers is interest rates. When borrowing money becomes more expensive, businesses earn less, consumers spend less, corporate profits begin shrinking, investors suddenly realize they may have overpaid for stocks. Then there's inflation. When everyday goods become more expensive, people have less money to spend, companies face higher costs, economic growth slows, markets hate uncertainty. Another major trigger: debt. But even economic problems aren't enough by themselves. Sometimes, investors create crashes all on their own, and that's where things get really dangerous. History is filled with bubbles: the dot-com bubble, the housing bubble, even cryptocurrency has experienced massive boom and bust cycles. A bubble happens when prices rise far beyond what an asset is actually worth. Eventually, reality catches up. Prices stop rising. Some investors sell, others notice. Then more people rush for the exit. That's exactly how panic selling works. And here's the scary part: markets don't crash because everyone wants to sell. Markets crash because everyone wants to sell at the same time. But if panic selling is so destructive, why do experienced investors often smile during crashes? The answer completely changes how you'll see the stock market forever. Here's something most beginners never hear. Every major stock market crash has eventually been followed by recovery. During crashes, strong companies become cheaper. Long-term investors quietly begin buying while everyone else is afraid. Patient investors see discounts. Think about it. If your favorite product suddenly went on sale by 40%, you'd probably celebrate. But when great companies go on sale, most people panic. The wealthy often think differently. That's an entirely different mindset. Still, there's one final piece almost nobody talks about, and it may be the most important lesson in investing. You cannot predict crashes consistently. Not Warren Buffett, not hedge funds, not television experts. Anyone claiming they know exactly when the next crash will happen should probably also tell you tomorrow's lottery numbers. The real secret isn't prediction. It's preparation. Diversify, invest consistently, avoid emotional decisions, keep cash available. Think in years, not days. The investors who survive crashes aren't necessarily the smartest. They're the most disciplined. Markets have rewarded patience for over a century. Fear comes and goes. Companies rise and fall. Economies expand and contract. But disciplined investing has remained surprisingly consistent. And that might be the greatest advantage ordinary investors have. What actually causes stock market crashes? Not one thing. They're the result of psychology, economic pressure, overvaluation, debt, and panic feeding upon itself. But perhaps the biggest lesson is this: crashes aren't just tests of the economy, They're tests of the investor. History remembers those who stayed calm, those who continued learning, those who focused on the long term while everyone else focused on tomorrow's headlines, because in investing, patience often beats prediction.
If you found this video valuable, subscribe to Investiora for more simple, evidence-based investing insights designed to help you make smarter financial decisions.
Thanks for watching. And remember, invest with knowledge. Grow with patience.